Well, the big question now, are all the analysts, investors and governments ready to say the word that they've until now considered taboo? That word? Recession. All the indicators certainly spell it out, and we'll discuss this more in a moment. But let's look at the cycle the world seems to be in and how it affects you, whether or not you have stocks or even watch Wall Street. Remember, this all began with a housing market crisis. People starting to default on their mortgages. The US was hit first and worst. That led to big loan providers and some banks struggling and a crisis of confidence in the banking system. Banks become reluctant to loan. People became reluctant to spend. That means cutting back on holidays, buying new clothes and even TVs. And if companies aren't selling, they need to cut jobs to save. And the circle goes around again and again and again. Well, joining me now from our London studio is Jeremy Batstone. He's Head of Research at Charles Stanley Stockbrokers. Thanks for joining us live on Al Jazeera, Mr. Batstone. I mean, is it about time now that governments and banks and financial institutions actually readily admitted that we are heading towards a recession, or we're in fact in a recession?
I think it is about time. One has to be very careful about using the word recession. We are certainly in a recession as far as the West is concerned. The United States is growing strongly over the second quarter, but we're expecting to see that growth slow quite markedly over the remainder of the year. But of course, globally, given the strength of Asian economies, the strength of the Middle Eastern economy as well, I think that the global economy is still growing reasonably positively. But it's incumbent on Western authorities to recognize the extent of the crisis, both in the real economy and in the financial markets. It's incumbent on them to do something about it. We've seen this now develop over the course of the past 14, possibly 18 months, if you want to go right back to the end of 2006. And yet all we have is the impression of authorities chasing their tail, playing catch-up, rather than trying to get on top of the situation. I think that with these collapses that we have heard about today, and perhaps in particular the concerns regarding AIG, the time for decisive action has been reached.
Can I also ask that the International Monetary Fund chief has said that the consequences of this current financial crisis are not over, but the root causes are behind us. I mean, would you agree with that?
No, I think that the residential property market continues to be in free fall. Although we have periodically 1 month worth of reasonably more upbeat data, we need more than a single month's data to convince us that the US residential property market has turned the corner. So if you consider that property is the root cause of the crisis, then we're not at the bottom of it. There is also another issue to deal with. US interest rates in 2003 were cut to 1%. There was concern over moral hazard because interest rates were being cut into a strongly growing economy and rising debt or rising leverage. Now, I believe the Federal Reserve can cut interest rates. Indeed, part of the market's partial recovery could be down to the fact that the markets are anticipating an interest rate cut from the Federal Reserve very, very soon. That's necessary. You don't even have to stop at 1% when we're going through a period of aggressive and prolonged deleverage, and we're still only really at the start of that. Then you can cut rates to 1%. You can even cut them to naught, as happened in Japan for a while in the 1990s, if you so wish.
Well, for the moment there, Jeremy Batstone, thanks very much for joining us. Great analysis there. And of course, we know that we'll be able to invite you back for more analysis as and when things develop. Thanks for joining us from London.